Welcome back to another amazing episode of Crusty Car News. It's smoking so badly, in fact, it's worse than a 3-year-old Kia. Yes, today we have 5 amazing stories for you. Jeep, Ram, Dodge, Chrysler, they are slashing their prices just to get people in the door. You're gonna find out more. Second story, proof we're finally in a car recession. Find out more about that. Strange times. Third story, dealers are finally signaling this car market crash that we're in the midst of. Fourth story, most cars are wealth killers, but guess what? Not all of them are, and I'm gonna share the whole story with you. The fifth story, the car market is finally bankrupt American buyers. This is a devastating time, so go ahead, sit back, grab your favorite beverage, and hold on tight. Let's get into it now. Life's too short to drive boring cars. The first story is all about breaking news. Jeep, Ram, Dodge, Chrysler, they're not selling vehicles. Their sales are in the toilet. But guess what? That's a win for you and I. We can get some massive sales, huge discounts. They're slashing prices. Unfortunately, things are getting worse. They're down 12% in terms of overall sales from the year before. They're putting on a 2-week hiatus in Canadian plant and shutting down production. And sadly, they're even lost a worker in the Dundee plant this week.
It happened this morning at the Dundee engine plant in Monroe County.
To make matters worse, with Ford, they just slashed a lot of their prices last week. But Ford has about 80% of their portfolio manufactured in the United States, and they were slashing prices. Employee discounts is what we're hearing. That's their A level. But now, to counter that, we know Ram has struggled. Jeep, Chrysler has struggled with sales on the downslide. Now they too are trying to counter what Ford has just done last week, and now they are also offering some big discounts, employee style discount. Beautiful red unit, definitely like the wheels, black decals. It has a nice look to it. For sure, we have a Ram 1500 Sport Crew Cab 4x4, and this one is a 2025, but this truck here retails for $77,000. So clearly not a low-cost vehicle at about $80,000, $85,000 out the door by the time you put on the all-weather mats, you put on paint protection film. Again, here's the same old song and dance, about $80,000. Now, even a small employee discount may not be enough to get people to buy these vehicles. Because I had a viewer reach out last week when I talked about the Ford discounts, and he was very much disappointed because he went down to some Ford dealers after this announcement. He wasn't getting any deals. He went down to look and ask about these employee discounts, and there was nothing given at 2 different dealers in his area. And with high prices of a lot of these Jeep products, we know the Wagoneer here as well, not selling particularly well. They had some increases in early of 24, but since then, sales of Jeeps have fallen about 10%.
You got a Wagoneer that's not really selling that good, so we don't work as many hours as we used to. We cutting shifts. You know, the other plants suffering too.
Which includes vehicles like the Wagoneer, the Grand Cherokee, as well as the Wrangler, which is one of the most popular models. Unfortunately, it's just not enough to keep the lights on.
And 900 U.S. employees being laid off temporarily as a result of idling plants in Canada and Mexico.
It's tough out here. Make it worse on me. Everybody's struggling right now.
Never support a layoff. I always want to come to work and make money.
And sure, while Chrysler, the product that's built in Canada, and all they really have is the minivan, went up by about 1% in this last quarter. Sadly, the Ram trucks, like we're looking at right here, has gone down by 2% overall sales in the first quarter of 25. And with prices on the Gladiator Mojave X 4x4 of $86,000, it's not a big surprise that these vehicles aren't selling. And Dodge sales of the Durango, the Hornet, as well as Challenger Chargers have been drastically down by about 49% in this last quarter. A clear sign of something major is going wrong. So in the same time frame that Stellantis is down 12% in this first quarter, General Motors is up 17% on their own, and Ford's only down 1.3%, which is an indication why Ford took preventative measures to sell more vehicles, to introduce the employee discounts. Now Stellantis is trying to do that with their entire lineup, with the exception of a few key models. In the midst of this cost of living crisis, where a lot of people are just struggling to get by and make ends meet, it seems like a lot of these manufacturers are becoming disconnected from the consumers that actually made them business and made them successful in the first place many decades ago. But a lot of these manufacturers now aren't necessarily in line with the affordability crisis. And a lot of customers, a lot of you viewers out there that are watching, realize that greed is taking hold. Of course, there's an increased cost of doing business. The CEOs and all of the VPs are getting top dollars. UAW is also adding wages increases almost every time they negotiate. And of course, on top of it, things like tariffs, increased costs at the supply chain levels are all adding costs at every layer within the organization, causing these prices to go through the roof. And while a lot of these companies truly try to justify and say, look, they're losing money and all they can do is give you $2,000 or $1,500 or $3,000 off of these vehicles, and that's employee discounts, most people are saying, look, we need to see more like 30, 40, maybe even 50% off. Not this $1,000, $2,000, that's not going to help at all. Now, Stellantis is saying that there's a couple of models that are excluded, one being the Wrangler 392 as well as the RHO Ram, which unfortunately we know those are the most pricey vehicles and they're likely the highest margins. So why aren't those included? Well, because there's a belief if you can afford those vehicles, then you're not worried about the taxes. That seems counterintuitive when the highest margins are buried in those vehicles. That's where they want to keep their money. They don't care about trimming $2,000 off of a base vehicle. Rather, they want to make sure that they have the money in those premium vehicles, which is a game that has been being played since the beginning of 2021, 2022, when they realized that selling only the premium models would generate the top dollars. As you can see, the lot's quite full. There's all kinds of trucks and cars. Now, a lot of these are the used vehicles, but even over here, we have a selection in brand new ones coming off the truck. So there's no shortage of inventory on the lots. And even with Ford ponying up to give the employee discounts, 80% of their vehicles are still manufactured in North America, which means that it's not a huge skin in the games in terms of these tariffs and the impact that they're going to have on the organization, even though Farley has himself said that this is going to blow a hole in the industry. But Stellantis has about 65% of the vehicles manufactured in US soil, meaning there's a much bigger impact because a lot of them are coming from Italy, a lot of them are built in Canada or Mexico, and of course that's going to have a devastating effect with these tariffs. Poor sales is going to continue this drive, this spiral downward. And I said this earlier in the year that I truly said what we're going to see is this race to the bottom. Ford, GM, as well as Stellantis. And that's exactly what's happening. They're all going to be battling for market share, and we're starting to see it happen now.
Stellantis temporarily laid off 900 workers in Warren and Sterling Heights and pausing production at assembly plants in Canada and Mexico.
And unfortunately, it's a common theme we've been hearing too long, layoffs. Toluca is laying off some workers. So is Windsor, Ontario, laying off a couple of plants for a couple of weeks. And on top of it, we're even seeing some workers over at Warren and the Sterling plants as well having to take some time off. Now, this has been a common theme. We've been hearing this time and time again. And layoffs have been an underlying action and a reaction to the market that's simply not buying. The production has to be sliced back because days supply and inventory continues to rise and the buyers just aren't there. So Stellantis is seeing declines in sales across the board. So is Ford. General Motors seems to be holding their own right now, but for how long? And how long can they actually make this continue on?
Given some of these discounts, would you be looking at a new Chrysler or Jeep, perhaps a Dodge product? I don't know, time will tell. Drop a line in the comment section. But also, don't forget to get your ebook, Used Car Buying Guide, I personally wrote with these fingers. Blood, sweat, and tears. It's an amazing book. If you've been out shopping, you're going to need to all the nitty and gritty. Down there below, don't forget to get your copy. Second story, proof. We're finally in a car market recession. Sadly for Audi, they're actually having to hold vehicles back. They're not importing anymore until they can figure out what to do next. With these tariffs, it's going to crush the brand. That's right, Volkswagen Audi Group is struggling with what to do. These tariffs, they struggle with trying to pass these prices down to the consumer, and yet in doing so, they're having to hold back. All they have is 2 months, maybe 3 months worth of supply. The industry average, where we once thought high day supply was a bad thing, now for many dealers and manufacturers, high day supply can be a good thing because vehicles that are on the ground are not subject to these tariffs. It's vehicles now that are newly imported after that first week in April. But unfortunately, it's not just VAG Group and Volkswagen Audi. You know, Ford as well just recently announced, we talked about that, how they're giving employee discounts for a lot of customers on the vast majority of their lineup. Same thing with Stellantis. A lot of their products are going to be subject to a lot of discounts for a lot of customers. Now, these are signs of things we never saw 4 or 5 years ago. During the pandemic, we saw there was a lot of challenges with consumers getting a half-decent price. Even paying MSRP and sticker was a rarity. But now we're starting to see vast amounts of vehicles going for well under sticker. In fact, so much so that we're seeing a lot of these prices just absolutely slashed. I was in a Toyota dealership today, had a conversation, and where there was once where Toyota would never even consider going below
MSRP, now they're willing to negotiate. I was actually chatting with them and they're willing to talk. They even openly admitted that they're willing to have a discussion. Same with Ford. Their interest rates are quite agreeable too. But on top of this, I did a search on CarGuru, and these are examples of what I truly believe is going on in the market. That's prices are coming down and massively coming down. Have you seen some of these EVs? The new Charger EV, absolutely not selling. Neither is the Wagoneer S, not selling. Hyundai Ioniq 6, now granted it's a couple years old, but they're new old stock. They're brand new vehicles. They sticker around $52,000 and change, and they're being asked $31,000 is the revised drop in price. Now they're brand new, and of course lot rot can be a problem. You know, if the vehicles sit too long, they can certainly have issues with batteries, tires, paint fade, and the like. But you talk about a vehicle that's now marked down in that 40% off of the original price. That's absolutely almost giving the vehicles away. Don't believe that one? How about a 24 Dodge Hornet? Let's pull this one up here. Has the 2-liter i4. We know the Hornets were struggling. Day supply was very, very high in the last couple of years. And in 2024, Stellantis could not necessarily sell. They were struggling selling the Hornets. You know, being a Alfa Romeo Tonale was certainly something that didn't inspire confidence in a lot of buyers. It was a fun, spirited little drive, but nobody wanted them. And, you know, as we look at the sticker price of these vehicles, they were around $37,310, but they were marked down here recently, as per CarGurus, to $25,460. I mean, again, you're talking, 35, 40, 45% off on some of these vehicles. And here's one, a 24 Equinox EV launch, stickered around $51,400, and now is on sale for a mere $34,900. So if you've been looking for one of those, it can be an absolute fantabulous deal. The new Dodge Charger Daytona RT, these are 24s, 25 model years. You're looking at the price tag on this one here, this 24, that's stickered at almost $71,000. But look, it's down to $52,792. That vehicle's cut in, well, I wouldn't say half, but it is getting close to half off. 40, 45% off of its original sticker price. These are brand new vehicles. Same thing with this other one, a 25 here that was stickered at $83,000 is now listed for $61,900. Again, 35%, a third of the discount, third of the price of that vehicle, right off the top. They're not selling. I pulled up this on CarGurus. If you have a look here, you'll see a whole pile of vehicles, and lots of them are heavily discounted. Now, when I say heavily, I mean, I'm talking maybe 10% off or thereabouts. I mean, not heavy as in they should be chopped in 50%. I agree. I think you and I and the rest of us would all agree that these prices have gone up too much in the last 3 to 4, maybe 5 years. But for Toyota to finally start cutting prices is a sure sign that things have gone off the rails. Like I said, I had a conversation with a sales manager today down at Toyota, and he had some confirmation that they're willing to talk. And if you look at this list, you'll see one thing in common. A lot of their trucks are not selling it well enough. I mean, they're moving some of the metal as well. But when you really look at it, you see Tundras, discounted by $3,000, $4,000. You're seeing Tacomas discounted by a couple grand. And when you really look through this list, you're going to find basically a lot of their trucks are discounted. They're off by $2,000, $3,000, $4,000. Pretty much standard. Like, a lot of their vehicles are going on sale.
I'd like to hear in the comment section, are you holding on to your cash or are you out shopping for the next new car? This could in fact be a good time to buy. Like they say, buy low, sell high. The third story, dealers are now finally signaling this car market crash. What's going on? Could it be that they're offering up huge discounts, incentives? This could be a great time.
With inventory levels rising, there was a recent rush in sales. As a matter of fact, General Motors has had some recent sales. A lot of that had to do with the announcement of the tariffs, where a lot of customers decided they better rush out and grab their next new car and do it very quickly. But when we look at sales, Ford is down about 1.3% in the first quarter, and Stellantis is down about 12 to 13% in sales. People are not buying. Sales are dropping drastically because in the last 4 years, a lot of OEMs and manufacturers have been cranking up their prices year over year, month over month. It seems like every time you step into the dealership lots, you're seeing a new revised price. And there was always extras added on, extra fees, where a lot of these manufacturers were loading up their vehicles with high trim levels, putting the mats on there, putting the PPF, and then you want to buy that truck, it already had those extras on it. And then there was market adjustment fees where a lot of dealers were trying to extract more money from the customers, and it left people wondering, where is the bottom ever going to fall out on this? During the cost of living crisis, it's pretty clear people are running out of money. And yes, there's those that do have the money. When you go shopping for your next new vehicle, it doesn't matter if it's a Ford, GM, Toyota, or any other brand, every vehicle these days is gone up drastically in price. Is it inflation? Is it greedflation? What is it? Well, it's a little bit of a combination of both. Most American buyers were used to buying their full-size pickup trucks. If they wanted to go truck duties, they often went by default to F-150, was considered a light-duty truck. But then along, of course, came the price increases on a lot of these trucks. And now a lot of these manufacturers are starting to introduce some of these smaller trucks. Yes, they've always been around, the old Chevy, GM, S10, S15s. But here we have a latest variation. This is a GMC Canyon AT4. But affordability doesn't even register when you're talking about some of these lower end trucks. This one here, granted, it's an AT4, it's a fairly decent spec. You get 4 doors, AT4, you get these beautiful alloy wheels, which looks like a derivative, certainly GMC product. They're very nice. They've got LEDs, certainly a bunch of detailing, but it is a small light duty truck. And even though you get a rear slider and all kinds of extra detailing and painted parts, these don't come cheap. There's a 25 Canyon AT4, and it has a lot of features here, but it also comes at $59,000. 60 grand for a Canyon? Plus taxes out the door, you're probably at $65,000. But it doesn't end there. We know that this greedflation has been kicking in full and high gear. And this has caused a lot of customers to make other choices. Buy something maybe used, secondhand. Well, the late model used vehicle lots are emptying out quickly too, because even those inventories are disappearing and customers are losing the ability to buy a late model vehicle, something with 0 or low miles, and do it affordably. Mid-spec or lower trim level vehicle like an Elevation with the 5.3 liter V8 engine there doesn't really have a lot of features in it, but it does come at a significant price tag. And even this truck comes in at a whopping $78,000. So you're way over $80,000 by the time you pay the piper and the taxes and the fees. So a lot of these dealers, and it doesn't matter whether it's any of these specific brands, they've all been catching on, and the big three have all been playing the same game. How about another one, a little Terrain small SUV? These aren't all that high end. I mean, how much can these possibly go for? Well, how about $41,000? But General Motors has had actually a pretty significant run. They've sold a lot of vehicles in this first quarter. But we see things about to change, because in early April, all of a sudden the introduction to these tariffs, which constantly go back and forth, and there's reciprocal tariffs, are causing people to make other choices. A lot of these brands, including the likes of Volkswagen, has just announced that they're going to start to pass those extra costs into some sort of a service fee. And the vehicles that they can't do that with are likely going to be grounded. Even car brands like Toyota, we're starting to see a lot of extra inventory sitting around on the lots. This wasn't something you saw a couple of years ago. But even the Tundras are piling up on lots too. They're not as popular, and a lot of them are even being discounted these days because of the lack of popularity, some of the issues with the engines, and they're not selling that well either. It's almost at a point now where Toyota's offering up extra deals, extra dollars off, and they're willing to negotiate. So while General Motors had a pretty solid first quarter, a lot of that had to do with truck sales. Their EVs are doing particularly well too, but again, a lot of it was bolstered on the fact that a lot of customers wanted to get their vehicle before these tariffs. Now the tariffs are hit, they saw a 14% increase in overall sales, but now with the tariffs, the conversation goes more to, look at all these extra vehicles on the lot. Nobody's buying anymore, it's crickets. And while stock analysts are saying that even though it's good that they're moving metal and they're selling their vehicles, just the sheer threat of the tariffs has General Motors quaking in their boots, and stock prices are taking a dive. So they decided to up and ramp up the production levels of a lot of their trucks to get them on the ground, of course, before the tariffs really come home to roost. Honda is another example of a brand that does have vehicles that are manufactured in Canada, and of course that will have an impact. With these tariffs applied, 25% plus seems to be the number. Of course, a lot of the production of parts and the metals that go into these vehicles are also having an impact on the overall cost. And then Nissan's hanging on by a thread. Sales are way down. Sure, they have a few spotty models that are making sales, but with their failed collaboration with Honda, they actually had a reaching hand that would potentially pull Nissan out of the fire. But last year in early 24, they virtually gave up all of their profits just to get people in the door, incentives. as well as marketing is what it took. They are trying to focus on bringing people back into the doorways, bringing people back to the brand. Here we see the latest Armada. There's also talk about the Xterra coming back, possibly in an e-drive format. And the Nissan Frontier is a popular little truck, but not selling as many as it likely should. This is the time for them to capitalize when Toyota is struggling with quality challenges and Nissan still isn't able to sell a truck. And the Volkswagen Audi group has nothing but inventory piling up every which way. Well, earlier in the week, Audi had announced that they're going to keep vehicles landed in Europe and not necessarily bring them to the dealership. It's all for the sake of avoiding the tariffs. But we're seeing inventory pile up still, and the products are not moving. As well, Volkswagen just announced they're going to start transitioning and transferring costs during the purchasing process to the consumer. And Volkswagen has decided to stop import vehicles into the United States effective almost immediately. And they've decided to hold their vehicles at the port in the US side of the ocean. And of course, that just means a lot of vehicles are not going to make it to the dealership. Those that are likely are going to see another line item. You know, instead of things like paint protection film, panoramic sunroof, and the extras, you're also going to see something that resembles an import tax or import fee that's going to be in a line item right next to all the other fees that they tack on. So as the second largest manufacturer of vehicles, Volkswagen is also starting to feel the hurt, and the customers are going to feel it too. Lots of vehicles by Chevy, and they're not selling. Nobody's buying. And the ultra popular Corvette, there was a time when you couldn't find one on a lot. But now there's Corvettes upon Corvettes upon Corvettes. They got E-Rays, they got Stingrays, Z06s, just about every color on this lot. I counted, as you keep going, I counted at least 45 Corvettes on this lot. Nobody's buying. With all of this extra inventory that Ford has on the lots, they're not able to sell these vehicles. I mean, prices continue to rise. And they've even said last year they were upping the price on vehicles like the Explorer. The Mustang's not selling. The EVs are only selling with incentives. And a lot of these trucks just are not moving. There's a time as well where the Broncos, you could not find them on the lot. But now look, we have several of them here to choose from. But you see, now Ford is also applying the employee discount. That's the A discounts. Same with Stellantis. They're not selling. Why would they do that if they were selling products? We're also seeing a lot of problems with the fact that sales are down by about 1.3%, which it should be way up after tax time when people have the extra money. They're deciding to buy something new and fresh is normally the time of the year, the spring, when buying frenzies start to happen again. That's not happening this year. And here, when you have vehicles like this little Tremor, this is a Maverick, gorgeous little vehicle, yeah, you get all the extras on there, all-terrain tires, but you also get an extra price tag because this one's here is $51,000. So people are starting to figure out even the small price point vehicles are going for significant dollars. We see what Chevy's doing, we see Ford, and all of these manufacturers are not able to move the metal. And that is having a major impact. Now, on top of it, these tariffs are going to finish it off. The finishing blow.
Are any of these incentives, any of these concepts, any of these big discounts enough to get you in the door? I'd like to hear more from you. The fourth story you've probably heard. Cars are one of the biggest wealth killers. Well, not all of them. That's right, I've got a list of some of the best vehicles that are gonna hold their value in 5 years. The depreciation is almost negligible.
The Toyota RAV4 is another vehicle that does not lose a significant amount of value, and you can buy that, comfortably own it for years. And a Honda CR-V has always been a safe bet as well. From an investment perspective, you can drive them, put a lot of miles on them. They're low cost for maintenance and servicing, but fortunately you don't lose a lot of money when you sell it in 5 or 6 or even 10 years. So if you're buying a vehicle in 25, here's some of your best bets and safest bets to keep that money in your pocket. So let's start from the bottom of the pile and work our way to the best. The first one is a Toyota GR Supra, and it looks like it keeps about 53.7% of its sticker price after 5 years. So 54%, that's not bad. It's not amazing, but after 5 years, it's still worth almost 55. It's like 54%. So it does consume a little bit of your income, but you're having some fun along the way, and it's a sports car. So if that was your plan and you're thinking a sporty vehicle, it's gonna hold some good value there for you. Another one is the Porsche 911. I already showed you an example of an older one. This one here, the statistics I saw was 53.8% or 54% of his value retained in 5 years. But actually, I want to say there's a caveat to that, because the numbers can actually be significantly higher on the 911. And the reason I say that is because the cabriolets, the Targas, those one-off, the convertible tops, are generally poor at depreciation. They give up a lot more money in the long term. If you want to keep most of your money in your pocket, and you might even keep a vehicle that, honestly, a Porsche 911 Coupe, maybe a Turbo, maybe a GTS, maybe a Carrera S, any of those vehicles that are coupes, wide bodies, and some of their fun, frivolous vehicles, even more so specifically turbos, GT3s even better, that's an anomaly, but vehicles with a manual gearbox often seem to hold some value. Now, there's a smaller niche market looking for those vehicles, but quite often the 911, you might even have 75, 80% of your residual tied up if you're buying some of those specialty 911s. So that's a great selection. Also showed you a vehicle there, a Toyota RAV4. I showed you an example of an older one, but basically you're at 53.9% of its original sticker can be held and retained within buying a RAV4. Now, you can drive them for a lot of miles, and it seems as though you can put a significant amount of miles and it doesn't have a major impact on the depreciation. And that's important, because it's one thing to buy a car that holds value if you don't use it and keep the miles low. We know there's a lot of vehicles like that. But as soon as you start cranking up the miles, they lose a value. It just goes right out the window. But a Toyota RAV4 generally doesn't lose value that quickly. So you're almost at 55%. You're only losing about 45%, so a little less than half in the course of 5 years. Realistically, what I've seen in the market, it's probably a lot higher than that. I'm actually being very safe and conservative. In most cases, if you go shopping in your local markets, you're going to struggle finding a vehicle, a 5-year-old RAV4 anyway. And if you do, it's probably going to hold a little more value than that. It's probably going to realistically be anywhere from that 54, what I'm seeing, even up to 65% of its original value. Keep it in good shape. Try to avoid banging into other cars, and you're probably going to keep a lot of value in that vehicle. The downside is the RAV4 is not a Japanese-made vehicle. It is made in Canada. And so if you want a Japanese-made vehicle, with a VIN number that starts with J for Toyota, your best bet for value retention is going to come with vehicles like 4Runners and some of those vehicles that have the J serial number. So if you're looking at a Toyota and you're not sure where it was built, the J vehicles are the ones that are going to hold the value. Another one here that always, as I just showed you, is the Honda CR-V with 54.4% of its value retained after 5 years. Again, that's being very safe, very conservative. In most cases, you're going to hold even more, because if you have a nice CR-V with a nice specification, it's the right color, and certainly more importantly, it's been well maintained and the miles are moderate. Again, you can use a lot of miles on there and it's not going to hurt you too bad. But I've seen a lot of CR-Vs and you cannot buy them for 50% of their value. In most cases, they're holding 54, 55, and sometimes even more, even up to 60% or beyond. So another vehicle that should be of no surprise, we saw some weirdness in that market a few years ago, and that's the Mercedes-Benz G-Class. That's about 56.6, about almost 57% of its value in 5 years. Honestly, again, very conservative. For a while there, we saw values actually going up. People were paying sticker, and then they were flipping them for even more money than they were. And that was because of shortages and people wanted, it was a hot model. Things have settled out, stabilized. Going forward, it is a premium vehicle. People are a little more conscious about their money these days. And some of the upscale vehicles that are going to cost you, $150,000, $200,000, $250,000 new, those are going to be a harder sell now, brand new. And so what you're going to find is the secondary market's going to follow suit. More shy people buying those on the front end, therefore less likely to buy them on the secondary market, unless they're proving to be good value. Because nowadays, in the last year or so, the last 6 months, people are looking more for value rather than features. The next one is the Ford Bronco. I just drove one of those, and I took it out for a review, and I enjoy them. I find them, the Badlands is a nice place to start. The Raptor is an amazing vehicle in terms of the fun, and they're great looking, but they're a significant amount of money. So they're not cheap vehicles, brand new, but if you're buying a full-size Bronco, not the sport's built in Mexico. It's basically built on an escape platform. It's not necessarily the most robust. Those that seem to own them seem to, like them, and a lot of people seem to take offense when I talk about the reliability issues around the Bronco Sports, but they are what they are. They're a smaller, price point vehicle for Ford. The big thing is, if you're going to buy a Bronco and you think you want to keep some value in there, you've got to get the full-size Bronco. Raptors hold good value. The Big Bend, I drove it, has a nice set of all-terrain tires on it. that's a great option. So you're looking at least 57.6, possibly 58%, or maybe even more. The way things have been in the last few years, you might even get closer to 60% of its original value in 5 years. The Broncos have been proving to hold up pretty good value there. So the Bronco, the next one is, and I just looked at one of those this week, a vehicle, I already talked to you about it. We know if you have a trustworthy brand that it's definitely worth its weight in gold. And Toyota is one of those that a lot of people are buying. We know that the outgoing V6 is gone, sadly enough, and now incoming is the 2-liter or the 2.4-liter Turbo 4. It's a wonderful vehicle, but what they're doing now is with like SR5s where you used to be able to get leather and sunroof, now the SR5 comes basically stripped out. You get leather or heated seats, but no heated steering wheel. It's a very stripped out model. So what they're doing is giving you less features in the same model trim. So it's less value brand new, but everybody trusts the 4Runner. It's been a great vehicle for years to come, or for years previous and years to come. And 4Runners are always an amazing buy. They always seem to hold their value. They're always built to last a long time. And again, a Japanese-made vehicle. So you're expecting at least 60% of its value retained in 5 years. I would say, again, even 60 to 65%, closer to that. Toyota Tundra, there's some challenges there. We know they've had some engine issues, but it's still a beautiful truck. And there's a lot of people believing that they're going to get this figured out, this new 3.4 turbo and some of those blown bearings in them. But I was at the Toyota dealer this week and I noticed there's a lot of Tundras in there for servicing, a lot of Tundras driving around, and I've been noticing a lot more on the street. So even though there's a recall for 100,000 of those going in to get new engines, the fact remains is there's a lot more of those sold, and quite frankly, people are buying them. They're popular, and I do believe that Toyota will get that problem sorted out. Nonetheless, predicted depreciation, you're looking to save or lose under 40%. So you're about 61% of its value kept in 5 years, possibly more, 65, maybe 70%. Again, Capstone, get the right specification, and you get the nice look, the TRD Pros, and all of those specialty models are definitely going to hold some extra value for you. Even though you pay more on the front end, they're definitely more attractive on the back end for the very specific models. Now, I don't necessarily suggest higher trim levels are going to get and hold a higher level of, a better level of depreciation or lack thereof. But with Toyotas, it kind of seems to go, especially if you're going with the more off-road all-terrain versions. Another one here, we've seen it. We know that the value of these vehicles seem to just hang around. The Chevy Corvette is one that seems to be holding. And now there's some great deals on the secondary market. There's a lot of great deals on the front end market. You can certainly buy them, get into one. There's a lot of incentives to push them out the door because there's just, they're caught up. Chevy's bringing out now new models. You've got the E-Ray, which is, definitely a more interesting model. You also can get, of course, the Z06, lots of those on the lots. That's the hot rod. That's the car I would buy. And the values are there to show it. Soon to be coming out is a ZR1 and, of course, the Zora. So those are basically hot models, and they all seem to hold a value now that Chevy's gone over to the mid-engine design. They're popular. They seem to be more popular to the mainstream rather than just, most people, the older Corvettes. It was a very specialist car, but it seems like it's reached out to a broader audience. And so, but you're talking about 61% of that value is kept in the car. The next one, of course, a drum roll, everybody, should be of no surprise, shouldn't be a shocker. Absolutely magnificent vehicles. And other than the fact that they've had some problems with transmissions, again, sorting that out, they're working out some of the bugs on that because it's a new redesign. Of course, it has that same 2.4-liter Turbo 4. We're talking about a vehicle that holds 64% of its original value in 5 years. Again, in some cases, closer to 70. And I've even seen vehicles that a lot of these dealers are asking, 75, 80, 85% of the original value, even after a few short years, just because the magnitude of the durability, the style of the vehicle, and the quality that usually goes into these. The Toyota Tacoma is that vehicle.
So maybe you don't care about buying new, or you're not worried about depreciation. Check out my book, another friendly reminder, the ebook about buying used cars. All the ins and outs, the good, the bad, the ugly, what you got to do next if you want to get a great used car and not lose your shirt. The fifth story. Yes, I hate to say it, the car market is bankrupting so many Americans. This is devastating. The car market is bankrupting Americans, and it doesn't look to be getting better anytime soon. I've been evaluating the market for the last couple of years, and what we're seeing are 5 major indicators why and red flags as to where this market is trending, and it's not good. But I'm also going to wrap this up. I'm going to give you a breakdown as to how this market got here, what we're looking at today, and for tomorrow, how you're going to manage your financing, how you're going to buy your next new car, if you're going to buy a car at all. I want to share some of those tips at the end. But let's summarize at the very beginning here, initially, how we got to this point. Again, after 5 years of this whole car market shift, we've seen things that we haven't seen since at least the crash back in 2008. Now, clearly, there's a lot of struggles out there. This all came on the heels of the tail end of 2020, when all of a sudden, everybody was stuck at home, things were changing, and the idea of buying cars seemed to be second nature. People weren't interested until handouts from the government came out. There was a couple key triggers to that. There was this projection that a lot of car manufacturers figured people are sitting home, they had to do a lot of factory shutdowns, and people weren't able to even use their vehicles, let alone buy new ones. So a lot of these manufacturers projected that we're going to slow down production, and as well, on top of that, it's coupled with the fact that these chip shortages were reduced. There was a drastic reduction due to droughts, and some of these chips that were coming from Asia were clearly not available. So while there was a production continuing on, a lot of the manufacturers just didn't have the chips to put into their vehicles. They would create these vehicles, these cars, trucks, and SUVs. They'd build them to about 98%, and then they were putting them on lots, waiting for chips, modules, all kinds of extra components that you just couldn't get. Along comes the end of 2020. All of a sudden, it started to shift. This projection wasn't entirely accurate because now with the government's handing out money, people were absolutely looking for something to spend their money on. Initially, it thought that people weren't going to buy, and then with chip shortages, vehicle shortages, extra money that was being handed out by the government, people actually were shopping, and they were shopping like piranhas in water. So what was actually happening now? Everybody was going down to their local dealerships, starting to race to get that next vehicle. The problem was supply and demand absolutely kicked into high gear. And we've never seen supply and demand in such an exaggerated case like we have since 2020. Because often what you were finding now, people were fighting over the same vehicle. You'd have 2, 3, 4, 5, 10 people bidding on the same vehicle. Dealerships got wise to that and realized, well, wait a minute. People are fighting over these. We could probably charge a little extra money. And so hence things like market adjustment fees came around the corner. Yes, it wasn't uncommon for a lot of these vendors to start charging extra, 5%, 10%, 20% over, and people were paying it. So, okay, on top of that, a lot of these manufacturers realized it didn't matter. People were spending with no real conscience. And so what was happening now, not only were people willing to pay over sticker for a lot of these base models, a lot of people were just electing easy come, easy go with the money, and they were buying high trim vehicles. So a lot of these manufacturers, we heard about Stellantis and Jeeps and Rams, and they started to produce less of their lower trim level vehicles, realizing, of course, that people are throwing money around like it's going out of style. So we're going to start selling all the high trim level products. So they didn't have to sell as many volume vehicles. They could instead sell fewer high trim vehicles and come out looking rosy, make much more money, and make the shareholders and the stakeholders, of course, much happier. I mean, ultimately, the goal and the objective for a lot of manufacturers, it's a commodity, is sell products to increase their profit margins. And as long as they're making increased profits quarter over quarter, they're happy. And this is what was going on for a couple short years. Of course, then things started to shift and change, and slowly people got wise to this, but interest rates started to change. Of course, shortly thereafter, back in 22, we all of a sudden saw a spike in interest rates. The idea was the Bank of Canada and certainly the Reserve in the US were thinking, okay, you know what? We can increase, that's our lever. Obviously, we're dealing with high inflation numbers. We better start jacking up these interest rates, lending rates. Interestingly enough, they did that and the buying never stopped. So these manufacturers continued to buy, sell high trim level vehicles and people continued to buy. But then that started to shift, and that takes us into some of the initial conversation about some of those key triggers that I'm seeing and some of the things that were actually happening. Unbelievable. Financial problems. That was a key thing, key indication. So since 2008, we saw an absolute bottom fall out financially. Of course, it's all been trending ever since, but what we've actually seen is now a new world of financial problems. That's right, repossessions. Car repossessions were up drastic amounts from the year before. Because what had happened was Now you had these higher trim level vehicles. We've seen prices that we've never seen before. Average transaction prices were rising. It was creeping up from high 30s, 40, 42, 45, 48, and now we're almost $50,000 for your average transaction price for a new vehicle. Of course, with these higher transaction prices comes along, people were still on fixed incomes. Well, the banks sort of loosened up the purse strings a little bit. They decided, you know what, we want to keep the economy rolling. Now the banks in cahoots with the manufacturers realizing that, you know what, we'll back off on how stressful, how strenuous we are and how tight we make these purse strings. Rather, why don't we loosen up a little bit? Let's not be so strict on the credit scores. Let's not be so strict on the duration of loan period. Rather, they were starting to push loans that were up in 72, 84 months and beyond. So now people that once looked at this expensive vehicle and thought, I'll never afford that, the bank said, well, you know what? We've got a deal for you. So now people with borderline credit scores were able to get into a long loan term, 84 months. So now that $80,000 vehicle that could have been an $1,800 a month payment, you know what? The banks were supporting that, lengthening out the loan term, even at a fairly high interest rate. Now you could chisel that down to $10,000 to $1,000 a month. But see, that's the problem. All of a sudden, recently, in 2024, we're hearing a lot of change. All of a sudden, the average vehicle loan dollar amount has risen to drastic amounts that we have never seen because of these rising vehicle prices. They said we're almost up to 20% of the car loans are over $1,000 a month, and that's in US. I've seen on the Canadian side, it's much worse. Most people are used to paying $1,200, $1,500 a month for a car payment these days. Even for a bare bones El Cheapo vehicle, something like a Mitsubishi Mirage, you're still stuck paying $700 a month. Things are not getting cheaper, but as long as the banks were enabling that, things were going around and manufacturers continued to sell vehicles. Well, we start to see inventory numbers rise, and that takes us to another point. Dealers not only realized that they could start adjusting or targeting market adjustment fees and people were paying it, they could do other tricky little ideas too. They had other factors, and I personally experienced this walking down to a Toyota dealer. But quite often what they were doing was preloading some of their vehicles and sticking them on the lots. So i.e., they would take a vehicle that was, sort of a mid-spec vehicle, and they would fill it up with all kinds of upgrades, roof racks, all-weather mats, maybe put a bigger set of wheels, powder coat the wheels. I saw this recently at a Chevy dealer. They just put on extra trim, paint parts, do all this extra powder coating, possibly purchase and have a key fob replacement program on there. They'd add all these extra paint protection film undercoating. And next thing you know, somebody comes in and they say, hey, I like that red Chevy 1500 you have out there. How much? Well, the sticker price might be $55,000, but that vehicle we're charging $63,000. What? But people initially, jaws were dropping, but they said, you know what? There's not a lot of inventory. Inventory levels are still sort of moderate. I don't have a big choice, or I have to wait significant amount of time to order mine in. You know what? I'll take it. I get it. And people were paying that. So these dealers were loading up their vehicles. They're dealing dealer markups on everything. So market adjustment fees, fattening up the product that they had, putting all kinds of extras and add-ons, and people were buying it. They were taking this. And this is very unfortunate because this is what started to lead down that path. Of course, along comes in between there, you had some of the North American manufacturers, Stellantis, Ford, General Motors, all going through transition with UAW strike workers. And in the midst of that, of course, there was a big push to get the frontline workers pay raises. Of course, we've never seen as well on the Stellantis side the raises that they saw at the CEO level. Carlos Tavares was one of the highest paid CEOs in the industry. So everybody was getting pay raises, from the CEO to the senior VPs to the UAW workers to just about everybody in between. We're hearing even in the EU unions, there was a lot of fighting and bickering with Volkswagen, VAG Group, because a lot of their union workers in Europe were also looking for raises. So this was going across the board. So labor costs shot through the roof, interest rates were rising, but now inventories were rising. So you would think everything would stabilize, but you'd be wrong, because people continued to buy. But then what started to happen was, manufacturers realized, okay, things were leveling off. They couldn't charge much more. They had pulled all the tricks out of their sleeve. And so ultimately you had now people starting to level out and say, you know what, common sense prevails. I don't need that vehicle. I don't need to pay over brand new price for a Toyota Highlander from what a used one is. I mean, used vehicles now, what we're seeing, interestingly enough, with some brands and manufacturers, I've seen this, and Toyota is one of the key ones, where they were doing the delivery in time. So every manufacturer seemed to come up with their own script. And Toyota came up with what they had, a delivery on time. They realized that as long as they had low inventory levels on the lot, buyers couldn't be fussy. You couldn't walk in the dealership and see 40 brand new Camrys on the lot. Rather, there might be one or two demos, and if you wanted one, you'd have to put your money down and wait. So this created this feeling of urgency. This created this feeling of, I've got to wait, so I better get on it. This created this feeling of, you know what, I need it and I can't wait. So they won on two counts. Number one, you couldn't negotiate, really. They weren't accepting negotiations, because if there's no inventory on the lot, what are you going to negotiate on? And they would stand on their number and say, look, sticker price. And in some cases, they were charging over sticker. To make matters worse, manufacturers like Toyota were charging as much for a 1 or 2 year old vehicle on their lot that was slightly used, maybe had 30,000 miles on it, and they were charging more than brand new. We heard stories like this: Highlanders, 4Runners, Tacomas, especially some of the models that were moving out. You know, the Tundras were moving into the V6. You know, we had the 4Runners were changing out of the V6 into the Turbo 4. And some of that transition was creating this flurry of activity to buy some special models. It was just an obscene time of and events. Dealer markups were getting out of control, and yet people were still buying. So that takes us to the next conversation. Inventory continued to rise. See, back in 2019, inventory levels, you're probably talking in that 2 million vehicles available on the lot, in the total industry in the market. Well, that started to creep down, of course, as this buying frenzy was building and erupting, and people were buying and they couldn't buy fast enough. We saw some of these inventory levels, days supply. In other words, if you stop production today by all vendors, here's how many days supplies you have left. We saw the day supply drop. We've seen the inventory drop. And then ultimately, you know, we were down to, you know, a little over 1 million, 1.2, 1.4 million vehicles available. From 2019, we were over 2.1, 2.2 million vehicles on in the industry. So that changed. The inventory numbers were down. Maybe you didn't get the pick of the litter. Maybe you didn't get the vehicles you want. And a lot of those vehicles were less desirable vehicles. So again, here we go. The manufacturers had to come up with creative ways. So that started to shift. You see, now you had manufacturers deciding that they've got to come up with some other crafty ways. It's called incentives. And Nissan was a classic example of one that took an absolute beating. Because if we heard Nissan, they had some of the biggest market share in the Japanese market. They were second pretty much to Toyota. Toyota and Volkswagen, some of the biggest automakers in the industry. And Nissan wasn't too far behind. But because some vendors, they lacked innovation. You know, Nissan they weren't doing much in the hybrid space. Sure, they had the Leaf on the EVs, but they didn't really do much for innovation. They were giving up on some of their popular models. And then brands like Nissan start to feel the burn. The sales were down. People weren't interested. Quality challenges, CVT transmissions, reliability, and people were just getting less and less interested in the brand as a whole. It got so bad, in fact, that the only way a lot of these vendors could sell these products, and a lot of these individual dealers could sell Nissans, was massive incentives, massive marketing campaigns. So much, in fact, the early part of 2024, would you believe it? They gave up 99% of their profits just because they couldn't move metal. So that left companies like Nissan floundering in the water, looking for support, financial. They were on the verge. As a matter of fact, late last year, they were talking they had 12 to 18 months left before there was a consideration they might be out of business. So there was a helpline thrown from Honda, and there was a discussion and a collaboration between those two vendors. But then it seemed like pride got the best of Nissan, and Nissan decided, no, we don't want to work under your terms, because ultimately Nissan was going to be a subsidiary of Honda. And coming from a place where they're one of the powerhouses, they couldn't let pride get the best of them. The CEO even managed to take a 50% pay cut. The CFO ended up quitting, jumped the ship, and now, months later, now we're hearing the CEO has been kicked to the curb, and there's a whole new CEO looking to try to make moves and try to bring Nissan back to the forefront. Things are changing and evolving, and we're seeing car brands that once had, you know, a powerful stance in the industry are now struggling. You know, we think of Stellantis. you know, the Alfa Romeos and the, you know, and the Maseratis are struggling in the North American market. So much, in fact, so there's rumors that they were likely going to be sold off to some other unsuspecting buyer. They weren't selling vehicles. Nobody wanted them. On top of it, brands like Chrysler, also Stellantis product, is nothing more than a minivan today. As well as Dodge, their products aren't selling. The Hornet, nobody wanted them. The sales were in the toilet, and they were some of the worst selling vehicles in the industry. So it was clear that a lot of these vehicles and these brands specifically, when Stellantis owns somewhere in that 14 different manufacturers or specific brands, they were considering selling off a bunch. A, to free up some capital, and B, just to stop the bleeding. Things weren't looking good for Stellantis. Nissan were struggling, and even Ford was feeling the burn. Ford was struggling because they were losing tens of thousands of dollars on this transition into EVs. But they were pushing hard to sell their Mustang Mach-E, the Ford Mustang F-150 Lightning. And so those vehicles weren't selling all that well. And the only way they could sell was massive incentives and major losses. They were hemorrhaging money. Still, to this day, Ford isn't doing all that well. Now, that takes us to other conversations. Tariffs. Now, the latest you've heard, it's been an up and down roller coaster of conversation with tariffs. Tariffs, of course, being taxes potentially up to and including and beyond 25% applied to initially. The talk was vehicles built, manufactured outside of the United States, and countries like Canada and Mexico were targeted heavily. Cars and trucks, you know, F-150s. Some of these vehicles were partially built or entirely built in Mexico or US. Some of the Stellantis products, Honda products were built in Canada. You know, we also had some of the full-size trucks built in Mexico. So the idea was to get them to start moving their manufacturing facilities to American soil. But that doesn't happen overnight. So not only did we see tariffs applied to vehicles, and probably as much as 40-45% of the vehicles in the industry would be impacted directly by these tariffs. This was having a major impact also in the steel and aluminum industry, which Canada was one of the major players. Of course, now you have a major tariff on that. To get that product into the United States, to use a lot of those products to build these cars and manufacture these vehicles, meant that it was going to cost a lot more to build these vehicles. Doesn't matter. Was it 25%? Not always, because sometimes part of the vehicle was built in Canada, maybe the rest of it was remanufactured in the US or part in Mexico. And so it wasn't always 25%, but there was a significant impact across the board. And this isn't going away. Now, the latest news, just today, we heard that there's a hold-off, 90-day hold-off on tariffs. But it's already done some work to the overall industry, the stock market. There's a sort of a volatility and a bit of a shyness in the industry and not sure where to go from here. Things were so bad, in fact, that Audi, Volkswagen said, nope, stop the vehicles at the port. We're not going to send them to the individual dealers yet until we know how to manage these tariffs. In fact, Ferrari even got on and said, look, we're going to actually apply, we're going to carry and own some of that tariff. We're going to absorb some of that. And they said, look, we'll put a 10% tariff increase on some of their vehicles, their premium vehicles, some of their more exclusive products. So all of these manufacturers are trying to come up with ways to sort of navigate this new tariff market. Impact or no impact, tariffs, the instability, the ups and downs, it leaves all of these manufacturers in a very unstable and a really awkward spot. It's ultimately going to cost the consumer at the end of the day. Most of these products that are built outside of the US will likely see increases in some form. We have other problems, and this is one of the other triggers. See, you know, we talk about people getting in over their heads. I already mentioned this in the beginning. These are another one of the key indicators that tells me this market is in real trouble. One of the key indicators is repossessions. Now, because a lot of these loan terms were extended out, because a lot of banks were helping people get into their favorite new car, and they were doing it on long loan terms. Of course, this transition to EVs was another problem. We know they depreciate really, really hard. But also taking a car loan out for 84 months almost virtually immediately puts almost everything outside of this way, from a specialty Toyota possibly. Almost every car manufacturer, almost every vehicle you can buy today, if taken out for 84 months or 96 months, you're going to immediately be in negative equity. Negative equity means you could drive it for a year, 2, maybe 3 years, and actually owe more. The outstanding balance on your loan is more than the retail value of that vehicle is. So if you go to trade it in, you owe on top of the trade-in value. So you could have a vehicle that, you know, you paid $30,000 for and you want to go trade in. You know, you've been paying for 3 years on it and you think you have all this equity into it, but you really don't, because it's only worth now because of depreciation, and you haven't knocked much off because the principal and the interest rates. You may actually still be in a position where you still owe $25,000 on that $30,000 vehicle that you've been paying for in the last 3 years. And then you want to go trade in for another $30,000 vehicle. You may actually have to pony up the difference, the extra 5K or so. And this is not an uncommon phenomenon. This is happening a lot. Because of these trade-in values, because of being underwater and negative equity, a lot of buyers were finding themselves in a struggle. A lot of people now were making decisions. You know, do I afford a car or do I just survive? You know, the idea of having food in the mouth, a roof over the head, or this big car payment for $1,200 a month. A lot of people are coming to their senses and saying these cars are out of hand. Like, this is out of control. So now you had a lot of people that were just grinding through it and trying to find a way just to keep making their payments. But unfortunately, you know, basically burying themselves in a negative equity state. So along with that, a lot of people were doing that. But unfortunately, a lot of people were saying, you know what, no, I'm going to let this default. I can't handle these payments. I'm underwater. I'm buried up to my, you know, in debt, my eyeballs in debt. I can't handle it. We need to keep eating. We got to pay the bills. And all of these factors started playing a point. Now, of course, as people were tightening their own wallets and coming up with new creative ways to sort of shed some of this debt, you know, where there's default and on their loans and possibly, you know, transition. And we've seen this move towards slightly lower cost vehicles in this last year, coming from larger SUVs to mid-size and subcompact SUVs. The car market's shrinking, but the subcompact SUV market certainly isn't. So people are changing their opinions on what they should be buying. But the point is, this is still a position where a lot of these vendors are trying to come up with creative ways to sell products. Well, how do they do that? The year-end, holiday season, tax season, when people are getting tax returns, when people are, you know, spending, or at the end of the year when, you know, there's a lot of these manufacturers are trying to shed their older model lineup. They're trying to do that. And so they're pushing a lot of products out with incentives, and people are still getting sucked in, thinking that even these latest terms by Ford, Stellantis are saying, oh, we'll give you employee discounts. And I talked about that here recently, but if you really break it down and you really, really look at what these employee discounts are, these A discounts, it's kind of a joke. Because, you know, you think, okay, here's a $80,000 Ford F-150 Lariat. Perfect. All right, I can go in there and I can get this A discount. I can get this employee discount, because they were offering discounts not to Canadians, but American buyers. So you think you're going in there to get a great deal. I've already had viewers tell me that there's no deals. Nobody's offering discounts. Even if the big CEO is saying there's discounts, each individual dealer still sort of manages their own profits in their own way. Now, if they're not transparent, that's another conversation. But the problem is, these discounts aren't so severe. I mean, you're thinking that $80,000 F-150 Lariat, oh yeah, I can probably get that for, you know, 60, 65. No. What we're actually hearing when rubber hits the road is these discounts more represent something that feels more like $1,500 off, $2,000 off, $2,500 off. That's nothing, considering in this last 5 years, we've seen some of the biggest car increases that we've ever seen. A spike that just went almost vertical. That's right, we've seen rises in some of the base prices, vehicle model to model. 5 years later, we've seen price increases anywhere from 20, 25, 30, 35%, even 40% and above for what they were 5 years earlier. Now, that doesn't include year-over-year inflationary rates. A lot of this is buried in profits. And these manufacturers are looking at ways to try to increase profits year-over-year, quarter-over-quarter. If they're not making profits, stock prices drop, CEO takes his walk-in papers. You get the gist? So there's a heavy incentive for the top players in every one of these manufacturers to make profit over profit. So they find it in any single way. The other day I was down at the Toyota dealer trying to understand how they're doing this. So their new 4Runner, they came out with a Turbo 4 and it's the SR5. And when I was chatting to this individual, he said, well, the new SR5 is basically the same price as the old SR5. Wow, well that's pretty impressive considering every vendor is going up in price. But he was quite And I do appreciate the frankness. I do appreciate the candor because he was open and honest. And when you look at the new SR5, it is stripped. It feels like a tackle box. It's plastic from corner to corner. There's no sunroof. There's no leather. The tech is very limited in it. It has basic highway rubber and it looks very dressed down. But oddly enough, the outgoing with the V6, better engine in my own personal opinion. It had a sunroof. It had leather. It had heated steering wheel and heated seats. It was pretty much a fairly loaded vehicle. That was the SR5 just 15 months ago. So what they're doing now is Toyota is stripping it down, giving you less vehicle, calling it the same model, but you're getting far less features. They're sort of dressing it down for the same money. So in other words, that's an inflationary adjustment. That is an inflationary increase. You're getting less vehicle for your money. Smaller engine, less features, same brand, same name, but you're getting less value for the money. And so that's another new way these dealers are managing this. They're giving you less products, the Chevys, the Fords. They're not giving you the sliders. They're maybe not giving you the sunroof or some of the extra features, but they're badging it the same way. So we're seeing a lot of unique ways that these manufacturers are managing bearing that inflation in there or bearing greedflation in there. So ultimately here's the deal. Those are all the triggers to me that are indicators. Big, powerful conglomerates are now looking at dumping brands that aren't selling. Stellantis is a key example. Nissan's trying to buddy up with another brand. These are indicators. High repossession rates, major indicators. Price increases that have nowhere to go. They can't go down. These manufacturers say they're losing money, and we're seeing it in stock prices. If they're not making these sales, they are in fact losing money. So the margins for new vehicles are relatively small, and these vendors or these specific dealers, a lot of the way they make their money is on extras or on the service department or parts. The sale of the new vehicles surprisingly are relatively thin in terms of overall profit margin. The majority of that profit goes to the OEMs, the actual headquarters. The rest of it comes in smaller, thin layers, and the idea is to sell extra extended parts and pieces and warranties and catch you on the service end. So that's where you're paying for that. So ultimately, how can you get through this to manage this and negotiate this catastrophic market that's constantly going up? And we don't see it going down anytime soon with these wavering tariffs, with these price increases, profit margins that have to make the next level. There just seems to be no way out in sight. So ultimately, there's a few key things that I'm going to share with you here. If you're in a negative equity position, let's say hypothetically you've bought a car and you're looking at negative equity. You check the balance and then you look at what trade-in value is. You talk to some dealers. And if you're buried in that and you need a new vehicle, my suggestion is do basically, ultimately the only real way out of it is not pay that difference. Ultimately, just use the vehicle for a longer period of time. Oh, and I forgot to tell you that's the other piece, is we're seeing the average age of vehicles on the road are rising. Another key indication. People are driving their old rusty cars, their old rusty trucks, their old rusty SUVs. I see it all the time on the roads around here where I live here in Alberta, where people in fact are electing to drive their old cars a lot longer, putting in brakes, starters, just keep them running. They might be rusty, put some fender flares on a rusty truck so it doesn't look so bad. People are getting creative because the average age on the vehicle, the average age of a vehicle on the road today now is about 13 and a half, 14 years. Whereas about 6 or 7 years ago, that actually average age was about 8 years. So people were flopping their vehicles through and buying vehicles more frequently. But now the cost it's prohibitive. So now instead people are just making them last longer. But to avoid the negative equity challenge, that'd be my recommendation, is own it long enough to make sure that you're not buried in negative equity, that you're not underwater. That's the big thing. The other thing is, if you need to buy a new vehicle, buy one at those key times. Go in there, negotiate. I also have a great look. Go to Car Gurus, a great way to shop. Look at the number of days. Car Gurus, you filter it out, and you can tell how long that vehicle's been on the lot. Those are the vehicles you negotiate on. Don't buy the latest and greatest because it's the latest and greatest iPhone. You're going to pay top dollars. So go in there, be sharp, be aggressive, and be willing to walk away at a drop of a hat. Never take the first buy, and don't take any of the extras. But ultimately, the best thing to do is wait it out. I mean, I know it doesn't seem like the prices are going to change anytime soon, But these dealers are getting desperate. They're consolidating and they're looking for new and creative ways, not just to hose you and consume your money, but in fact, they are trying to incentivize constantly. But is the incentives enough? Ford, Stellantis? And did you ever come across the video that I shared about our new Camry that we bought and how the dealer absolutely hosed us? You're going to want to find that out, as well as don't forget to get your copy, the ebook, of course, that I just wrote, Used Car Buying Guide. Hope to see each and every one in the next one. Have a wonderful week, everybody. See you then. Bye-bye.